Hi, this is Jason Coddington with Coddington Wealth Advisors, and we'd like to have you join us this month for our May 2020 Student of the Month series provided in conjunction with BlackRock. And what we'd like to talk about this month is volatility, some interesting learnings about the municipal bond market, as well as something we can learn about stocks that we haven't seen before. So go ahead and join us, and we thank you for your time. All right, thank you for your time, and let's get started to May 2020 Student of the Market, and a lot to learn in this month, so we'll go through it, and hopefully we can learn some information from this that will help us become better investors and ultimately help us with our portfolios that serve our long-term investment goals. So first off is we'll look at historic market volatility in this presentation, of course, presented by BlackRock. We look at the number of single-day stock market returns of either positive or negative 2% or more. And so if it feels like it's been a bumpy ride the last 4 months, well, it absolutely has been. And to put it in perspective, since January 1st of this year, we've had 31 days of trading that have had either a positive or negative 2%. Now, to put that in perspective, in all of 2019, we had 7. And in the year before, in 2018, we had 20. So just in 2020 alone, and it's basically the end of since January 1st, if we look at that, we've had more trading days greater than or less than 2% than we did all of the 2 years prior. And if you look back over time in 2017, we had 310 days without a 2% trading day from November 8th of 2016 to February 1st of 18. So again, if it feels like bumpy, well, it is, and it absolutely feels that way because we've had kind of a smooth ride, historically speaking. So we'll we'll move forward, and again, we haven't seen this kind of volatility since back during 2008 and 2009. So next, we'll kind of look at the best and worst days and months for the S&P 500 since 1950. You can see there's a lot of March 2020 data in here. There is one April in there. So we did have one great day of 7%, historically speaking. In April, we had a couple good days in March, and we'll learn just how well the market has done since hitting the bottom on March 23rd, 2020 of this year. We'll review that soon. But the key here is if we look I want to focus on the worst days and worst months. Is if we look at a year after the worst days and the worst months on average, historically speaking, again, and no, doesn't mean that this is going to happen again, but historically speaking, once we have, a bad period of time, it's typically followed by historically a good period of time. So if you look 1 year later, 24%, on average after any one bad day. And then if we look at worst months, on average, 20.5%. So again, probably, we don't know what's going to happen here, as you can see, and we're still left to find out. But historically speaking, stocks typically bounce back. So this next one is important to look at because we've had a pretty good return. Since the market bottom, so on March 23rd, 2020, we were down 34% on the S&P 500 since for instance its market high. And in this particular case, you can see it's bounced back 30%. So that's caused given people a lot of comfort despite the volatility. However, we have to also remember in 1987 and 2000 that the market dropped, came back up, and then fell again. and then at the same time also did that in 87. So we need to be cautiously optimistic here as investors. So, don't be surprised that there's some volatility, continued volatility going forward, but over the long run, again, stocks, as we've seen, do historically outperform other asset classes. The one part that's buried in this slide that I would really want to focus on is this investment math. And it's a very important point, probably one of the most important pieces in all of this deck, is that some people think they lose 34% and they make back 34% and they're back to even. That's not the case. If you lose 34%, it requires a gain of 51.5% to get back to break even. So, just keep that in mind, and that's again why it's very important to stay invested during these times. And as it goes forward, stocks, historically speaking, have seasons, and where in a calendar year they perform better at certain times of the year than others. And so when we look back to 1926, and tracking stock market data, we have two periods of time that we'll focus on. One is called Turkey to Tax, which is basically November 1st to April 30th, or around Thanksgiving to around tax day, April 15th. And you compare that to mommies to mummies, or around Mother's Day to around Halloween. And you can see that historically speaking, since 1926, 7.3% rate of return from November 1st to April 30th, as compared to 4.2% from May 1st to October 31st. So there's a big difference there. And so, but what's more important is if we draw a line right here and look at the last 20 years, it's been a 5% rate of return in the comparative November 1 to April 30 period, as opposed to, the May 1st to October 31 period. So what that means is, if we go back and look, this 30% return, we don't know if that's likely to continue given the season that we're in. So this mommies to mummies period that we're going into is historically a lower rate of return environment of stocks. So we need to be prepared for that looking forward over the next 5 to 6 months. This next piece is important in the sense that it's only happened 3 times since 1949, and that is that the 20-year rolling performance of bonds is better than stocks. That happened just recently, March of this year, March 31st, 2020. It also happened in February of 2009, which you can see here, and also in 49. So that's very rare, because historically speaking, stocks always outperform bonds, but there's been this snapshot in time where the 20-year rolling period is bonds have outperformed stocks. Now, what does that mean going forward? Well, if we look to 49 and following the next 5, 10, and 20 years, stocks strongly outperformed. If we go back to February of 2009, again, the following 5 and 10-year periods, stocks strongly outperformed. Again, we don't know if that's going to be the case in the future here, but definitely want to look at stocks are highly probable to outperform bonds going forward. So we want to again look at that, and we'll talk about what type of bonds going forward. So, and that brings us to this particular slide where when we have bond portfolios and we're trying to reduce risk of the bonds that you have in your portfolio, a lot of times we go with a short-term duration bond. So that takes less risk than basically your overall aggregate bond or core bond index, which is represented by the United States Aggregate Bond Index. So again, this is the risk, and this is the so you would think that, okay, well, something that has more risk, if you will, or more standard deviation is going to perform worse. Well, if we look back this past year, just year to date, you can find that the riskiest investment, historically speaking, of this comparison performed the best, and the ones that had the least volatility performed the worst. So it's very important that when we look at the bonds in your portfolio, what is their objective? Is it for risk reduction, or is it for income, or is it for both? And we may want to reevaluate those positions in your portfolio. And another interesting time frame that we're in, this period that we're in, given this COVID-19 virus, is that the municipal bond index is greater than the taxable bond index. So you can see that here. So tax-free bonds or municipal bonds are paying more than taxable bonds. And so what that means is you're kind of getting a bang for your buck, literally speaking, because you're getting a 2.25% yield and there's no tax on it. Whereas the taxable bond yield is 1.31% and you're paying tax on it. So it's going to be important to review your bond holdings in your particular account, because if you have taxable bonds in your portfolio, they're currently not only underperforming tax-free bonds, but you're also paying tax on it. So want to reduce that exposure if possible, or consider that where they're appropriate in your portfolio. So that being said, a lot to learn this past month in May, with quite a few anomalies with the muni bonds, the rolling 20-year returns. So a lot to learn from that, and just as we prepare going forward. If you have any questions about how this information applies to your own individual investments or portfolios or your long-term financial goals, please don't hesitate to reach out, contact us, and we'd be glad to go over any questions you might have. Thank you for joining us this month. We look forward to next month in June, where we have another Student of the Market. Thank you, and again, if you have any questions, please don't hesitate to contact us.